no, no. Bear Stearns is fine. Do not take your money out. This is real. Look, if there's one takeaway other than a plus 400 somewhere, Bear Stearns is not in trouble. I mean, if anything, they're more likely to be taken over. Don't move your money from Bear. That's just being silly. Don't be silly.
Okay, just so you get a sense of what's causing the agony by this point, I know you've been talking about it. It's financials led by Bear Stearns after what essentially is a bailout from the Fed.
This is about Bernanke. This is about Bernanke. He has to be on that call. Forget the investors. The investors are going to do, if Bernanke listens, Bernanke needs to open the discount window. That's how bad things are out there. Bernanke needs to focus on this. Alan Greenspan told everyone to take a teaser rate and then raise the rate 17 times. And Bernanke is being an academic. It is no time to be an academic. It is time to get on the Bear Stearns call. Listen, open the darn Fed window. He has no idea how bad it is out there. He has no idea.
Right, it's been a hard week for shares of Bear Stearns as the firm has been buffeted by constant rumors of a looming liquidity problem. Bear maintains that its balance sheet, capital positions, all strong. The stock, which rallied yesterday, still down 17% over the last 5 trading sessions. Joining me now first on CNBC is Alan Schwartz. He is Bear Stearns president and CEO. Mr. Schwartz, thanks so much for being here this morning.
Good morning, David.
Good morning. Let me start off with this broad idea that's been in the market now for a few days and pressuring your stock, namely that counterparty risk is something, new counterparty risk is something that a number of firms on Wall Street no longer want to take in terms of dealing with Bear Stearns. Is that true?
No, it's not true. There's been a lot of volatility in the market, a lot of disruption in the market, and that's causing some pressure administratively on getting some trades settled out, but we're working hard getting that done. We're in a constant dialogue with all of the major dealers and the counterparties in the street, and we are not being made aware of anybody who is not taking our credit as a counterparty.
All right, so when I'm told by a hedge fund that I know well that last night they tried to close out a mortgage, a credit protection mortgage position with Goldman Sachs that they had bought a year ago, Bear was the low bid, and I'm told that Goldman would not accept the counterparty risk of Bear Stearns. You're saying you're not aware that that would be the case?
I'm not aware, and on a specific trade from one counterparty to another, and where you're a third party, we have direct dealings with all of these institutions, and we have active markets going with each one, and our counterparty risk has not been a problem. Some people could speculate that Bear Stearns might have some problems in there since we're a significant player in the mortgage business. None of those speculations are true, but it's a market that... It's okay, David. So I don't know where the rumors started. Maybe I could just say this. I think that, part of the problem is that when speculation starts in a market that has a lot of emotion in it and people are concerned about the volatility, then people will sell first and ask questions later. And that creates its own momentum. We put out a statement, I did, that our liquidity and balance sheet are strong. Maybe I should expand on that a little bit.
Well, yeah, why don't you? I mean, when you say something like that, give me some examples. You and I had an interview about 2 months ago when you had just taken the job. You were fairly positive in terms of Bear having taken the marks that you thought were necessary, having treated its balance sheet conservatively in terms of level 3 assets. Right. So had things changed? Have they gotten worse over the last 2 months?
Well, the markets have certainly gotten worse, but our liquidity position has not changed at all.
Okay, Peter writes, should I be worried about Bear Stearns in terms of liquidity and get my money out of there? No, no, no. Bear Stearns is fine. Do not take your money out. This is real. Look, if there's one takeaway other than a plus 400 somewhere, Bear Stearns is not in trouble. I mean, if anything, they're more likely to be taken over. Don't move your money from Bear. That's just being silly. Don't be silly.
Okay, just so you get a sense of what's causing the agony by this point, I know you've been talking about it. It's financials led by Bear Stearns after what essentially is a bailout from the Fed. Bear Stearns shares are down 90% this morning, and it's not just Bear. Pretty much every single bank is plunging in early trade this morning. Lehman, which is very similar to Bear and its reliance on fixed income, is down nearly 30%. You have big names like Goldman Sachs down 8%, Citigroup down 8%. So it is pain across the board this morning, and as you know, it all emanates from the shock this weekend that J.P. Morgan, along with the Fed, was going to be bailing out Bear Stearns for $2 a share. This is a stock that recently was trading at 80. Last year was trading at 160. It is the fifth biggest bank on Wall Street. It is significant in that it is establishing a price for some of these hard-to-value securities, and as you are well aware, that price is pretty much zero, and that's why you're seeing pain across the street.
Due to the stressed condition of the credit market as a whole and the unprecedented speed at which rumors and speculation travel and echo through the modern financial media environment, the rumors and speculation ultimately became a self-fulfilling prophecy. Because of the rumors and conjecture, customers, counterparties, and lenders began exercising caution in their dealings with us, and during the latter part of the week outright refused to do business with Bear Stearns.
Schwartz said that left few options.
The choices we faced that Friday night were stark. Find a party willing to acquire Bear Stearns by Sunday night, or face what my advisors were telling me could be a bankruptcy filing on Monday morning, which could likely wipe out our shareholders and cause losses for certain of our creditors and all of our employees.
The Federal Reserve helped orchestrate the deal, committing $29 billion in taxpayer money to back assets as part of an agreement for J.P. Morgan Chase to buy the stricken firm at a cut-rate price.